If you want to understand what just happened in the silver market, stop watching the price during the day. Start paying attention to when no one is supposed to be watching. Because the most important moves don't happen on CNBC. They don't happen during regular trading hours. And they don't happen when liquidity is thick and orderly. They happen quietly, late, when the lights are off and the story hasn't been written yet. What you're about to hear is not about a chart pattern, a breakout level, or a hot trade. It's about why a market behaved in a way it's not supposed to behave, and what that tells you about the system underneath. Most people are trained to look at silver as a slow, boring metal, industrial, plentiful, predictable. But when a market that's supposed to move politely suddenly jumps violently, outside normal hours with no headline to explain it, that's not noise. That's information. And here's the part most people miss. When price moves like that, the message isn't where silver's going next. The message is what's starting to break. Stay with me, because to understand this, you have to stop thinking like a trader and start thinking like the system itself. Most people are trained to look at markets the same way they look at the weather, up or down, hot or cold, good news or bad news. When silver spikes, the immediate reaction is always the same. Who bought? What news came out? Is this a breakout? That framing misses the point. Because markets don't just move on information, they move on structure. Mainstream financial media treats silver like a side character. It's either an industrial input tied to economic growth or a speculative trade that gets attention when it suddenly jumps. What they rarely talk about is how silver is priced, where that pricing happens, and who actually controls the flow of metal versus the flow of paper contracts. Most coverage focuses on the visible layer, charts, headlines, daily percentages. But the real story lives underneath that. Inside the mechanics of futures markets, inventory classifications, settlement rules, and liquidity conditions. Think of it this way. A price move during a busy New York session tells you what traders think. A price move during thin, off-hours trading tells you what someone urgently needed. Those are very different signals. When people dismiss sudden overnight moves as low liquidity noise, they're assuming the system is healthy. They're assuming there are plenty of sellers, plenty of supply, and plenty of confidence. But in stress systems, thin liquidity doesn't mute price action. It reveals pressure. The mistake most people make is treating silver like a normal commodity in a normal market. This isn't a normal market. And when you look at it through that lens, the question stops being, is this a real move? The real question becomes, why did the system allow it to happen at all? Let's slow this down and anchor everything to verifiable facts. The price movement that triggered this discussion occurred during the Globex electronic futures session, which is the overnight trading system operated by the CME. Globex runs nearly 24 hours a day and handles futures trading when U.S. pit sessions are closed. Liquidity during these hours is consistently thinner than during the New York session, especially on Sunday evenings. During this Globex Open, silver futures experienced a sharp upward price gap, moving several percentage points in a very short time frame. This type of move is commonly referred to as a gap and run, meaning price jumps to a higher level without trading through intermediate prices. Now let's place that move into context. Over the past year and a half, COMEX registered silver inventories, the category of metal specifically designated as available for delivery against futures contracts, have remained near multi-year lows. Registered inventory is different from eligible inventory. Eligible metal exists in vaults but is not committed for delivery. Only registered metal can satisfy delivery demands from futures holders. At the same time, open interest in silver futures has remained elevated, meaning a large number of paper contracts remain outstanding relative to the amount of metal actually available for delivery. On the physical side, retail and wholesale markets have shown persistent stress. Premiums on physical silver products, coins and bars, have remained elevated compared to historical norms. In many cases, U.S. retail premiums have stayed several dollars above spot price, while international premiums have often been higher. Multiple dealers and mints have reported periodic delays in fulfillment and limited availability on certain products. According to industry data compiled by the Silver Institute, the global silver market has recorded annual supply deficits in recent years. These deficits occur when total demand, including industrial use, jewelry, silverware, investment demand, and photovoltaics, exceeds total mine production plus recycling. The difference is filled by drawing down above-ground inventories. Importantly, industrial demand has not been static. Silver usage in solar panel manufacturing, electronics, automotive systems, and defense applications has increased as energy transition policies, electrification, and advanced technologies expand. None of this means prices must move in a straight line, but it does establish a factual backdrop. Tight registered inventories, high paper open interest, elevated physical premiums, ongoing structural deficits. Against that backdrop, a sudden off-hours price dislocation is not occurring in a vacuum. It's happening inside a system where supply buffers are already thinner than they appear on the surface. Now that we have the facts on the table, the important work begins: interpretation. Not prediction, not hype, interpretation. When a sharp price move occurs during thin Globex liquidity, one possible explanation is simple imbalance. A buyer arrived when there were not enough sellers willing or able to meet demand at the prevailing price. In a healthy, well-supplied market, that imbalance is usually small and short-lived. But in a system already showing signs of strain, those imbalances can widen quickly. One possible interpretation is that some participants are becoming less confident in future availability, even if prices remain lower during regular sessions. That doesn't require panic or conspiracy. It only requires risk managers asking a basic question: what happens if supply tightens further and we wait too long? Another explanation may involve positioning pressure. Futures markets rely on the assumption that contracts can be rolled, offset, or settled without meaningful friction. If certain large players are carrying significant short exposure while inventories remain constrained, even a modest surge in demand can create stress. That stress doesn't show up as headlines. It shows up as sudden price jumps where liquidity is thinnest. It's also possible this reflects institutional timing, not speculation. Large buyers often avoid peak liquidity periods to minimize market impact. Executing during off hours can reduce visibility, even if it increases price movement. That kind of behavior suggests urgency rather than opportunism. There's also a broader strategic layer. Silver sits at the intersection of monetary history and industrial necessity. Governments, manufacturers, and strategic planners don't think in quarters. They think in years. If policy-driven demand for energy infrastructure, electrification, and defense materials continues, securing inputs early becomes rational, even at higher prices. None of this guarantees continuation. Volatility cuts both ways. A Globex move can retrace if follow-through demand doesn't appear during regular sessions. But strategically, what matters is not whether price holds every tick. It's whether confidence in paper availability is quietly eroding. Markets rarely announce structural change clearly. They whisper first. And when those whispers show up as off-hours dislocations, it's often because the system is adjusting before the narrative catches up. If this were only about silver, it wouldn't matter much. But silver doesn't exist in isolation. It sits inside a tightly connected financial and industrial system, and when stress shows up in one node, it tends to migrate. Start with markets. Modern commodity markets are built on leverage, trust, and assumptions of smooth settlement. When prices move abruptly outside normal hours, it challenges the idea that liquidity is always available when needed. Over time, repeated dislocations can lead participants to demand wider risk buffers, higher margins, reduced leverage, or earlier hedging. That changes market behavior, not just price. Now consider banks and intermediaries. Bullion banks and large financial institutions play a central role in price discovery and liquidity provision. They operate on models that assume futures markets remain dominant over physical flows. If physical tightness increases and delivery risk becomes more than theoretical, those models need adjustment. Even small changes in risk management assumptions can lead to reduced market-making activity, which ironically increases volatility further. Currencies are part of this story too. Silver has historically functioned as a monetary metal, even if modern systems downplay that role. When confidence in fiat systems weakens through inflation, debt expansion, or geopolitical fragmentation, hard assets tend to regain strategic importance. Not because people expect currency collapse tomorrow, but because diversification away from purely financial claims becomes rational. Governments are watching this closely. Industrial policy in the United States is now deeply tied to critical materials. Energy transition, semiconductor manufacturing, defense readiness. These all require secure supply chains. If key inputs experience persistent shortages or price instability, policy responses follow. That can mean subsidies, strategic stockpiles, export controls, or regulatory shifts. Zooming out further, this reflects a broader global trend: deglobalization. As nations prioritize domestic resilience over maximum efficiency, commodity markets become less elastic. Supply that once flowed freely across borders becomes conditional. That raises the probability of localized shortages and sudden price moves. None of this means the system collapses tomorrow, but it does mean the era of smooth, predictable commodity pricing is likely ending. What replaces it is a world of tighter buffers, higher volatility, and more frequent stress signals. And those signals tend to appear first, quietly, where paper meets physical reality. This is the point where most market commentary loses people, because it stays abstract. So let's translate this out of charts and systems and into real life. When structural stress shows up in something as basic as silver, it eventually touches areas people don't associate with metals at all. Start with cost of living. Silver is embedded in everyday technology: electronics, appliances, vehicles, medical equipment, energy systems. When input costs rise or supplies tighten, those costs don't disappear. They get passed along, slowly and unevenly, into the things households buy and rely on. You may not see silver surcharge on a receipt, but you feel it through higher prices and reduced availability. Now look at jobs and wages. Industries tied to manufacturing, energy infrastructure, and advanced technology are sensitive to supply disruptions. When materials become harder to source, companies delay projects, stretch timelines, or cut margins elsewhere. That pressure can show up as hiring freezes, slower wage growth, or fewer opportunities in sectors that are supposed to be expanding. There's also the impact on savings and purchasing power. Periods of commodity stress often coincide with currency stress, not collapse, but erosion. When real assets become more volatile and more valuable relative to cash, it highlights a quiet reality. Money sitting still tends to lose flexibility over time. That doesn't mean panic buying assets. It means being aware of what your savings can and cannot protect you from. For families thinking long-term, education, retirement, healthcare, these dynamics matter. Not because silver itself becomes central to your life, but because it acts as an early signal of strain in systems that affect stability. The key takeaway isn't fear, it's awareness. When inputs tighten, systems adapt, and adaptation always has a cost. Understanding that early gives you time to adjust expectations, plan conservatively, and avoid being forced into rushed decisions later. That's the real value of paying attention before headlines catch up. This is where I want to give you something you can keep using long after this specific moment passes. I call it the structural lens. Most people look at markets through headlines. Some look through charts. The structural lens asks a different set of questions. Where is price discovered? Who controls supply versus who controls paper claims? What assumptions must remain true for the system to function smoothly? Instead of asking, is the price up or down? The structural lens asks, what had to fail or stretch for this move to occur? Applied to silver, this lens shifts attention away from daily candles and toward inventory classifications, registered versus eligible, settlement mechanics, liquidity timing, policy-driven demand, geopolitical constraints. Under this framework, off-hours price dislocations aren't anomalies. They're stress tests. They show you where the system is least flexible. They reveal which assumptions are no longer being taken for granted. The structural lens also forces intellectual humility. It doesn't predict outcomes, it maps pressures. Sometimes pressure releases upward, sometimes it releases downward. But pressure always leaves clues before it breaks. This way of thinking is useful beyond silver. You can apply it to energy markets, housing, banking, even labor markets. Anywhere paper promises rely on real-world capacity, the same questions apply. If you build the habit of watching structure before narrative, you stop reacting late and start observing early. That's not about being right on price. It's about being early on understanding. This is where we turn awareness into practical discipline, without hype, without predictions. First, separate signal from noise. Not every price move matters, but where and when a move happens often matters more than the size of the move itself. Get in the habit of noticing off-hours volatility, Repeated stress around settlement periods, persistent gaps between paper prices and physical availability. Those aren't trading signals. They're system health indicators. Second, reduce forced decision risk. The biggest mistake people make during volatile periods isn't being wrong, it's being rushed. Forced selling, forced buying, forced reactions usually come from overexposure, leverage, or unrealistic expectations. Whatever assets you hold, the goal is simple. Structure your finances so you don't have to act during moments of stress. Third, think in layers, not bets. Avoid all or nothing thinking. Systems rarely break cleanly. They stretch, wobble, and adapt. That means preparing for a range of outcomes. Temporary spikes and pullbacks. Policy responses that calm markets short-term. Long-term structural pressure that doesn't resolve quickly. Flexibility beats conviction when uncertainty is high. Fourth, watch behavior, not commentary. Pay less attention to what institutions say and more to what they do. Inventory trends, margin changes, delivery incentives, policy adjustments. Actions reveal priorities. Narratives follow later. Finally, optimize for resilience, not excitement. Resilience looks boring. It means diversification, liquidity, conservative assumptions, and patience. It means understanding that volatility is a feature of stress systems, not a personal test of intelligence or courage. You don't need to predict the future to prepare for it. You just need to avoid being fragile. That's the edge most people never think about until it's too late. What you witnessed wasn't a signal to rush, panic, or chase anything. It was a reminder. Markets don't fail loudly at first. They signal quietly, through behavior that doesn't fit the story we've been told. A sudden move outside regular hours doesn't mean the system is broken tomorrow. It means the system is under strain today. And strain changes incentives. It changes timing. It changes who moves first and who reacts later. You don't need to take sides. You don't need to make dramatic decisions. You just need to see more clearly. When you start paying attention to structure instead of headlines, you stop being surprised by outcomes. You recognize stress before it becomes crisis. You give yourself time to think, adjust, and respond on your own terms. That's not about silver. That's about how modern systems behave when assumptions start to slip. Stay curious, stay grounded, and remember, the most important signals rarely announce themselves. They appear quietly even when most people aren't watching.